We always say that it's earnings and interest rates which drive the stock market, but these days it's more of the medical data that's driving the stock market. That said, there's still value in listening to what companies have to say. Looking at companies from the bottom up can give us a picture of what the overall economy looks like. Listen in as Jeff DeMaso, Kate Austin, and Charlie Toole take a look at what they're hearing from individual companies. This is Jeff DeMaso, and I'm the Director of Research here at Advisor Investments. We're here with another Advisor You Can Talk To podcast. Today I'm joined by Kate Austin and Charlie Toole, two members of our Dividend Income team. Thank you both for joining me. I know it's your favorite time of year, or rather favorite time of the quarter, earnings reporting season. This is when companies tell investors what worked and what didn't work in the prior quarter and give us a sense of where they're headed in the future. This is always a busy time of year for you two and your colleagues. I think you typically listen to over 100 calls a quarter. And since earnings drive stock prices over time, every earnings season is important. But given the pandemic, the shelter-in-place orders, our attempts to reopen the economy, well, this season seems to carry more weight, both in terms of hearing how companies fared as the economy ground to a halt and how they're planning to get through this. So you two are the experts. I'm going to stop hogging the mic here. As a roadmap, I'm hoping you two can take us through what happened in the first quarter, how companies are responding, and what we're hearing from companies about the months and quarters ahead. In effect, we can try and take what we're hearing from individual companies and maybe you can paint a picture of the overall economy. I know the first quarter feels like ancient history, but before we move forward, I think we have to understand where we are today. And I don't think it's going to surprise anyone to hear that earnings fell or declined in March, but just how bad was it?
Well, Jeff, in a word, it was bad. As you mentioned, earnings and interest rates drive the markets, and our clients have heard us say that for a number of years. But for the first quarter, the first 3 months of 2020, earnings are expected to be down about 15% from where they were last year. And to put that in perspective, many people may not remember this, but last year was a year of zero earnings growth for the S&P 500. So we're really going back to levels that we saw at the beginning, or we're down 15% over where we were in 2018. And this was for the first quarter when really the economy was open for January and February and closed or we had shelter in place for most of March. So the second quarter is probably going to be worse because we were shelter in place for all of April and we're just starting to open now here in the first week of May. So the expectations for earnings in the second quarter are going to be down 40%. But we are seeing a divergence across different sectors. There are sectors like healthcare and staples that have shown positive growth. And there are other sectors like industrials, consumer discretionary companies, and financials that were really down a lot.
Yeah, so I think, like Charlie was saying, a lot of it is kind of expected. Industrials, consumer discretionary, and financials have been down the most. But it's kind of what you would expect. Delta reported a loss for the first time in 5 years. Obviously, there is no business demand for airlines or personal. Nobody's taking vacation this time. AMC theaters actually had to announce a delay in filing their quarterly report as revenues really kind of vanished overnight. So they're really having to try and, put a Band-Aid on this kind of wound. And, a company like Disney that is making their money by bringing tons and tons of people together, that's not really going to be a winning strategy going forward. So they're trying to have to look at what they've been doing. And so all of these companies in these kind of travel, leisure, entertainment sectors have definitely been hit hard. And, financials has also been hit hard with the Fed reducing rates to virtually zero. The banks can no longer make as much money as they used to on the spread between rates that they give for deposits and rates that they make on lending. So they're really having to rely on other sources of income, like one-off fees, trading revenues, investment banking revenues. And so we've kind of seen a bit of a dispersion in between the larger banks and the smaller banks. The well-capitalized larger banks are faring a little bit better than their regional peers. So companies like JP Morgan and Bank of America, they have huge, huge balance sheets and should be able to weather this storm a little bit better. But for some of the smaller banks, who are they doing business with or who are they lending money to? a lot of small businesses that are really being hurt by this crisis. So in turn, they might be hurt a little bit more too.
Right. And Kate, one of the other things that we've been seeing is a lot of companies are reducing their capital expenditures or their capital spending. And really, like people in the economy, companies are tightening their belts. And we're seeing companies cut back on the spending that they're going to do. I know UPS said they had plans to upgrade a lot of the vehicles in their fleet, and they've decided not to do that. NBC Universal, which is part of Comcast, they're halting construction projects at theme parks in Orlando and Japan. And this is what's hitting the industrial sector. When these projects are pulled back, there's less use for construction equipment, there's less use for hand tools, there's less use for the all this industrial equipment that's used for these projects. So that's what's hitting the industrial sector.
That all makes a lot of sense. If we don't quite know how consumers are going to come back and how quickly, it's hard to invest in a big project. And as you say, there's a lot of knock-on effects, not just for the company that's holding off on the project, but whose tools they were going to use to construct those projects. So, what else are you hearing from companies? Are they just cutting back projects, or are they taking other steps to try and survive in this environment?
Honestly, companies are trying to do basically anything that they can to preserve capital. It's a little bit more than belt tightening, I would say. It's really like, how can we ride out this storm, because we don't know how long it's going to last. We don't know all of the knock-on effects, and we don't know how the consumer will react. So one of the things that we've seen is really kind of just trying to get some of the low-hanging fruit. Um, a lot of companies are suspending buybacks and withdrawing guidance. About 50% of the companies that have already reported have scrapped guidance. So basically saying, we don't really know what's going to happen, so we're really not going to guide for earnings or revenues for the rest of the year. Suspending buybacks, there's been more companies than I can count that have suspended their buybacks. Again, it's just an easy way to preserve the cash and help shore up their liquidity. Many companies are also trying to raise as much capital as they can now. So, for example, Intel drew down on a $10 billion revolving credit facility. The idea is, while cash is available, get it now. And then with rates near zero, a lot of companies are actually locking in a significant amount of debt for 10 or 20 years at these low rates. So Visa, for example, locked up a 7-year tranche, a 10-year tranche, and a 20-year tranche at about a 2% rate, which is very low going forward.
Right. And one of the other ways that companies are responding, we've heard from several companies that they're reviewing their supply chains. And so over the last 12 to 18 months, it's really been a difficult environment for the global economy. First, we had the trade war with China and the tariffs that were issued on goods produced in China. And then you had COVID-19, which essentially shut down the global economy. And so this has companies reviewing where they're getting their products from, how they're putting their products together. A number of companies have called out that they're reviewing their supply chains and they want to bring a lot of that production back to North America. And so that can be a good thing for some companies, specifically in the transport sector. Union Pacific, which is a railway company, talked about how a lot of their clients are looking to bring back production to North America. And so that is a way that I think companies are responding to the 1-2 punch of a trade war and then a global pandemic.
Well, Charlie, I think you hit on something there that maybe you guys can draw on a little bit more. The idea that some companies are, and I don't want to say winners and losers, because it's not really the right language for this environment. But in this dynamic period, some companies are going to come out a little bit ahead or are faring a little bit better or stand to benefit from changes in behavior or supply chain. So can you talk about some of those companies or what you're seeing in from that angle?
Totally. I think, winners and losers isn't like, you don't want to say this company will win, this company will lose. But what we've really seen kind of going forward is the quote unquote winners are really taking advantage of some of the larger secular shifts that are happening in the world and really accelerating that shift. So obviously telehealth has kind of really exploded. It was definitely available before, the pandemic hit. But now I think people are realizing that a lot of things that you had to usually go to the doctor's office for, you really can do virtually. So it's kind of forcing the world's hand to innovate or adopt technology that's already there. Another one is, how do you entertain yourself when you're at home? Gaming has been exploding. Microsoft saw a 200% increase in their gaming uh, business segment. Obviously, it's an easy way to pass the time. Netflix, again, huge increase in new users this past quarter. What else are people doing when they're stuck at home? And, another one is just this overall shift of digitization and moving to the cloud. As people are working from home, people need access to things from wherever they are. And the easy way to do that is on the cloud. And Microsoft said that they saw 2 years of digital transformation in the past 2 months, which is just mind boggling.
I think one of the other ways that companies are faring better is just they're adapting to the new reality. And an example is Verizon. And previously, before the pandemic, a Verizon technician would come to your house and install Fios, for example. Well, now they can't come into your house. So how does Verizon continue to expand Fios to their customers? They've created what they call Fios in a box, which they'll send the box to the client or to the customer. The technician will come and connect Fios from the utility pole to the house, and then the box has all the instructions for the customer to finish it on the inside. And so that's a way that I think a company has adapted. But there
Oh,
are
they're just getting us to do the work, Charlie.
it is cutting costs. It's cutting costs for the technician. But I think really, when you talk about, again, winners and losers, Kate mentioned a lot of companies that are seeing or taking advantage of this stay-at-home shift, whether it's working from home, medicine at home, installing your Fios at home. Companies on the other end of that spectrum are the ones that are suffering the most. If you're not an essential business, but you are a manufacturing plant, you can't be open. So you're not making your product. And those are the companies that I think are struggling specifically, or in addition to that, retail. Those stores aren't essential, so they're not open. So you think of the retailers that are selling clothing or auto manufacturers selling cars. Those are the areas that have really struggled.
Let's pick that up of the idea of reopening the economy. There's clearly sectors that are itching to get that return to normal. And Kate, I know you said half of the companies have pulled their guidance, um, which is a pretty shocking number. But what are you hearing from company management about the quarter ahead? Are there any insights into what reopening might look like?
So it's pretty unknown, really. Most company management teams do expect another contraction in Q2. Like Charlie said, Q1 is pretty bad, and Q2 is expected to be even worse. But there are some positives. So there are signs that the stimulus checks are working. Both Apple and McDonald's reported an uptick in the second half of March as well as April as some of those stimulus checks hit. Apple, for example, had really stellar online growth, showing that consumers are still wanting the new AirPods or watch or what have you. But obviously, if the retail store is not open, they have to buy it online. And because this return to quote unquote normal looks like it might be a little bit longer than expected, there's been some uptick there as well with, oh, maybe I should, fix my laptop or, get a new router or something like that. And McDonald's actually has, they said that drive-through is driving now 90% of their sales versus about 65% prior to COVID. So again, it's just going back to this whole idea that companies are really having to innovate, and those with structures in place already are really kind of steps ahead. Like, it's easy for you to drive through to McDonald's to get your lunch or whatever. But if you wanted to go to Olive Garden, they don't really have a drive through. So you'd have to do curbside pickup, which is just another opportunity for the customer to really say no.
And just to piggyback on those companies that are trying to adapt like Olive Garden, I think one of the takeaways I've heard from a lot of management teams is they just don't know what the new normal or the new reality is going to look like, and how their customers are going to want to fit into their business in that new normal. A couple of examples that I've seen: airlines. Kate mentioned before that people aren't traveling for business or for pleasure, but when they're allowed to do that, what's it going to be like sitting on an airplane? Is there going to be somebody in the middle seat? Are they not going to sell the middle seat? I've heard the idea of turning the middle seat around, which seems really weird for me flying on a plane, looking at the person in the row in front of you. Um, Another example is casinos. when casinos open, how they're going to try to keep their customers safe is having uh, basically plastic barriers between them and other players or them and the dealer. So imagine sitting at a
Hmm.
blackjack table and it feels like you're in a phone booth because there's plastic between you and the people next to you and between you and the dealer. So there's all these new normals that we're going to see coming out of this as we open.
Yeah, and I think one of the other interesting points too is, there's a lot of the large firms will always have, expectations at the beginning of the year for what they think the full year is going to look like. And these are some of like the smartest analysts, really good economists, all of that. And they kind of project their expectations for S&P 500 earnings for 2020. And usually those expectations are grouped pretty close together. There's a little bit of a delta, but not too much. But really for 2020, after the whole COVID thing, the COVID pandemic started to happen, a lot of analysts, all of their expectations were really more of like a scatter pattern than, closely clustered together. And three analysts actually completely threw up their hands and withdrew their guidance. As analysts, we're really used to working with incomplete or imperfect data, but this is imperfect data that's changing week to week, month to month, and a lot can happen between now and Q2, let alone the end of the year. So it's not that surprising that a lot of these analysts and economists, their forecasts are so wide now.
Right. And one of the things we've been trying to do as an investment team is sort of look at other areas of the globe to see what this looks like. So obviously this outbreak started in China and the recovery has started there as well, as China shut down their economy and shut down their cities, but now they're reopened. So we can use them as sort of a test case on what the growth trajectory is going to look like coming out of this. And a few companies have commented that while growth hasn't returned to pre-pandemic levels, it has picked up. And whether it's companies like Visa, who track uh, obviously credit card and electronic payments, or a company like UPS, which is doing shipping and transit in the country, both of those companies commented that once the economy started to reopen, after about 2 weeks, they really started to see growth pick up. So that's sort of a tell, if you will, on what could look like not only here, but in the rest of the globe as we start to reopen economies.
No, it's encouraging to hear that like there's signs of economic activity picking up. That said, it's still pretty easy to paint a negative picture. People are spending less. They're going to get the unemployment rate this week, and it's not going to be pretty. Probably 15-20% people unemployed would not be um, outside of expectations. But that translates to companies earning less, which means there's less cash coming in company coffers and less cash to pay out to dividends and shareholders, which is I know where you guys focus. So help me out here. How does this work for a dividend focused investor or strategy?
Well, I think Kate used the term earlier that companies are trying to ride out the storm. And our clients have always heard us talk about battleship balance sheets. And this is the reason, or this type of environment is why we prefer to invest in companies with battleship balance sheets, because they can ride out the storm easier than others. You mentioned, companies are not seeing as much in revenue or in profits, well, then they can tap their stronger balance sheets for liquidity to be able to manage through this tough time. And so investors that are relying on dividends, they're going to start to see a decrease in the dividends that they get, basically essentially getting a pay cut. One of the things that we've been watching is there's a dividend futures contract that the CME group has. And this contract, the price of this contract essentially is describing what investors think dividends paid by the S&P 500 will be for 2020. And that contract is running about 15% lower than the contract from 2019. So that basically is saying that investors expect 15% lower dividends in 2020 versus 2019.
Yeah, and unfortunately, like Charlie was saying, for those companies that don't have those battleship balance sheets, another one of those low-hanging fruits, if you need to conserve cash, is cutting or suspending the dividend. Again, it's really more of a last resort than stopping buybacks, because the market really typically punishes companies that cut or suspend their dividend, because clearly the company doesn't have as much liquidity, and that doesn't really bode well for normal business operations. But now what we're seeing is companies are doing it so much more. More companies have actually cut or suspended their dividends this year than the past 10 years combined, and we're only 4 months in, right? So because the amount of companies are cutting or suspending is so much larger, the market is kind of giving a little bit more of a pass, I would say, than they would in years past. And we're kind of seeing some interesting companies that are either cutting or suspending. So, for example, TJ Maxx had a bit of a sneaky cut, I would say. So they announced it in their 10K, but not really anywhere else, that they were not going to pay a dividend for the first quarter of 2020. But because people rarely read the full 10K, it kind of slipped through the cracks, and none of the news agencies were reporting it. Royal Dutch Shell is another example. After paying a dividend for 75 years, so they've paid a dividend since World War II. But with the price of oil falling off a cliff so much, and so many of their revenues are tied to the price of oil, they really had to cut. And then again, in kind of like travel and leisure, Ford, GM, and Carnival, they had all really seen their revenues basically go to zero. And these companies were really already under some financial pressure when times were good. So they definitely did not have Battleship balance sheets. And I am a big Warren Buffett fan, and one of his sayings is, you don't really know who's swimming naked until the tide goes out. And those that cut the dividends were probably swimming naked a little bit before, the coronavirus pandemic happened.
Right. And Jeff, I wouldn't say that the news is bad across the spectrum. There are some companies that are strong that have in fact raised their dividends over the last 3 or 4 weeks. And Kate mentioned Apple before as having seen some uptick and having a strong financial position. Apple announced a dividend increase last week. Johnson and Johnson and Costco and Procter and Gamble all announced dividend increases 3 to 4 weeks ago. So there are companies that are still able to raise their dividend in environments like this because they are so financially strong, so well capitalized, and run by good management teams.
And I think, Charlie, you bring an interesting point too, because I think so many investors are always focused on the dividend yield. How high is the yield? What's the yield? But a lot of investors almost forget that dividend yield is really more of a valuation tool than it is a barometer on a company's health or their liquidity. So if you think about the dividend yield, it's the annual amount of dividends in dollars divided by the company's current price. So if the numerator stays the same and the denominator craters, the yield is going to spike, right? And so there's another saying that a high dividend yield is always highest before it doesn't exist anymore. And with all of the companies that have cut or suspended their dividend, we've seen that yield spike right before. And so I think it definitely drives home Charlie's point that just, consistency, strong balance sheets, and good management teams with a well-run business are way more important than a high dividend yield.
No, I think that's spot on. I know it's not just true in the stock market, but the bond market. Our bond guy, Chris Keith, always likes to say that the yield is highest just before there is no yield at all. So rings true for all types of investors. Charlie, Kate, I want to thank you both for joining me on this call. I think it's been really valuable to hear what you're hearing from individual companies. And if I were to try and sum it up, it seems like there's no sugarcoating it. We're in a difficult environment, and the road ahead is not as well lit as we might like it to be. But there are companies that are adapting to the new environment. There are companies that are well positioned to weather this storm and continue to pay out those dividends to investors and continue to serve that role in their portfolios. So thank you both for joining me today. This has been Jeff DeMaso, Kate Austin, and Charlie Toole from Advisor Investments, thanking you for listening to the Advisor You Can Talk To podcast. If you've enjoyed this conversation, please subscribe to or review our show. You can check us out at advisorinvestments.com/podcasts. Your feedback really is always welcome. If you have any questions or topics that you'd like us to explore, please email us at info@advisorinvestments.com. Thank you for listening, and stay safe.